Hey everyone, welcome back to Corporate Decoder, the place where we try not to fall asleep reading corporate filings so you don't have to. And today we're diving into some deals with warrants involved, which is a bit like finding out your ice cream comes with homework. This report is all about OS Therapies and some financial moves they're making. It involves selling some stock warrants and issuing new ones, aiming to raise money. We'll break down what warrants are, why this matters, and peek at the financial implications. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss this and other companies. Scroll item 1.01, entry into a material definitive agreement. Scroll quote. First off, let's talk about what this report actually is. It's called an 8K filing, which companies use to tell the SEC, a government agency, about important events. In this case, it involves something called a warrant exercise inducement. Basically, the company is trying to encourage people who already have warrants to buy shares of their stock. Think of a warrant as a coupon that allows you to buy stock at a specific price in the future. OS Therapies previously reported on a similar event. They're now completing a second closing of this offering, which is kind of the official term for this deal. So what exactly are these warrants? Certain individuals or entities held warrants allowing them to buy over 1,500,000 shares of OS Therapies stock at 1.1000 ENTS per share. To get these warrant holders to actually use those warrants, the company offered a deal. If they exercise their old warrants, they get new warrants to purchase another 1.5 million shares, but at a higher price, $3 ADS per share. These new warrants are exercisable immediately and last for 5 years. Of course, things could change. If the company does stock splits, which means dividing existing shares into multiple shares, or issues more rights offerings, the price and number of shares these warrants represent could change. Scroll resale registration statement. Providing count for the resale scroll, the company is promising to file paperwork with the SEC so that those who get these new stock shares, known as the new warrant shares, can resell them to the public, which is called the resale registration statement. They need to do this within a month of this closing and hustle to get the SEC to approve it within 60 to 90 days. Certain existing warrant holders have agreed to convert over 500,000 existing warrants into new warrants. This second closing of the deal will bring in about $616,000 for the company before they pay their expenses. Let's dig into the terms of these new warrants, but without getting too lost in legal jargon. For the specific legal form, you can check Exhibit 4.1 in other previously mentioned document. So, warrants let you buy shares at a set price, which is the term we call exercise price, and in this case it's $3 ARI. Remember, these warrants are good for only 5 years. Now, what if the company sells more shares later at a lower price? That would usually upset the warrant holders, so there's a protection in place. If it happens, the warrant exercise price drops to the dilutive issuance price, which is the lower selling price of the new shares but never goes below $1. That's for each share. Good news, they can use the warrant whenever they want, partly or fully, to buy new shares. Bad news, to ensure no personate is able to build a massive amount of control. Anyone who is holding warrants has limitations. A holder can't use their warrants to an extent where they would own more than 4.99% of the company, unless they specifically agree to 9.99% of the company. Unless they specifically agree to 9.99%, it might sound complicated. But it's basically a rule so single holders don't get too much power. Now, there is also forced exercise. If the company's stock price skyrockets to 3 times the warrant exercise price, then the company can force the warrant holders to buy the stock for cash. What if the resale registration isn't cleared? Then the holder who wants to buy company shares can basically swap the warrant for the shares instead of putting in cash. Importantly, holding a warrant doesn't give you the same rights as holding common stock like voting. The one exception is that you do get to participate in the dividend payments if the company pays dividends. Big changes coming if the company gets bought out or goes through a massive restructuring, which is known as fundamental transaction. The warrant holders get protection. The holder would receive shares of the new company or still of OS Therapies if they survive the restructure. If they don't want the shares, holders can also request cash in the amount as if the warrants were exercised. Finally, slight modifications in the warrants can be made, but only if the company and the warrant holders agree to the modifications in writing. Scroll, their information contained edge in item 1.01 of this current report on Form ACAC scroll, since they are selling equity without registering it. We need to point to item 3.02, which mentions that they are relying on Accession, since they are dealing with sophisticated participants in the market and not a massive amount of people. The report is signed by Paul A. Romness, MPH, President and CEO of OS Therapies Incorporated. Dick, now, taking a step back, what does all this mean? OS Therapies is using warrants as a tool to raise capital. By incentivizing existing warrant holders to exercise their options, they're bringing in cash now in exchange for potential dilution of their stock later. The terms of the warrants, like forced exercise, are generally advantageous to the company, which is beneficial for existing stockholders as opposed to the warrant holders. The warrant holders generally want control, protection from changes and dilution control, which some are present, but from my perspective favor the stock performance of the company. The success of this strategy hinges on a few things: the company's stock price, their ability to get those resale registrations approved, and whether they can avoid triggering those price drop protections. A risk to remember is OS Therapies is essentially betting on their future stock performance. If the stock doesn't do well, the warrant holders might not exercise their options and the company won't get the cash they're hoping for. Also, issuing these new shares will slightly lower the value of the existing shares' dilution, something current shareholders shouldn't ignore either. Alright, that's our breakdown of OS Therapies' latest filing. What's your take on these warrants and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And again, don't forget to check out the Discord in the description. Thanks for watching. See you next time.